Welcome to Real Talk, Real Estate Discussions with Andrew Karsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Karsh.
Welcome to another edition of Real Talk. Assuming this gets posted on Wednesday, July 16th, that will be my 50th birthday, half a century old. I can't believe it. I'm one to love birthdays, one to embrace the celebration of myself. I am a bit narcissistic that way. But this birthday, not as excited. Not as excited as turning 50. But I know everybody says the 50 is the new 40, and that those that are in their 50s or older say that the 50s are their favorite decade. So I'm holding you all to it. I'm holding to the fact that the 50s will be my best decade yet. On this episode of Real Talk, I have Jeff Karsh, the founder of Tryperion Holdings, on. Jeff is a very astute, well-respected real estate professional. We had a great conversation talking about his company, Tryperion, how he's a value real estate investor, agnostic to asset classes, and even where he sits in the capital stack. We talk about, his vision for the company and how he's seen the marketplace today. So I hope you enjoy my conversation with Jeff Karsh, and here's to another 50 years. Welcome to another edition of Real Talk. I'm here with my good friend, Jeff Karsh. Jeff, how you doing?
Pretty good, Andrew. How are you?
I'm doing great, and great offices of the father's family office in Tryperion. Beautiful, beautiful build out. So thank you for inviting me here.
Thank you very much for being here.
So I have to start with a very controversial question. Is it true that Jeff Karsh is the number one pickleball tennis player or pickleball player in the real estate industry in LA?
Well, I had to say no because you qualified it with LA. I'd probably say nationally, but if I said that, then my good friend Lou Friedel might look at me funny. My other friend Keith Rosso might also look at me funny. But no, I love pickleball. It's a fun competitive sport. It's a racket sport. I played tennis in college. I loved anything with a racket. And then, when I learned pickleball, called 5 years ago, I couldn't stop playing. So I love the game. Thanks for asking.
Absolutely. I know we've played together, and, I missed the Deco Capital Shlomi Ronin pickleball tournament from a couple weeks ago.
Champion.
You're champion.
I'll show you the trophy.
I seen it on a picture. Austin Richter, my good friend, I was supposed to play with him, and I was down in San Diego, so I had to bail. And did you beat Austin in the finals, or?
I'm not sure Austin made it to the finals.
Okay. You are sure,
Did he make it?
I don't know. Okay. I don't know, but no, I do know about your pickleball prowess, and so I don't think I could ever beat you. I can only join you. That's the only way I will win.
Anytime.
So obviously we'll talk about Tryperion, a company that you've had for how many years now?
12 years.
Wow.
2015.
Tryperion and Sklar Kirsh.
We tried, we had a lunch in like 2012, end of 2012, and we both talked about this in Century City, how we were starting our own firms.
Yeah. Amazing. Well, I want to hear all about Tryperion and your thoughts of the market, but let's rewind even more back. Where'd you grow up, and tell me about your childhood?
Yeah, I'm originally from here in LA, actually in Pasadena, where I grew up.
I don't think I knew that.
Yeah, until I was about 13 years old. I was the only Jew in Pasadena. I thought I was the only one in the world. I actually went to a Christian Science elementary school, believe it or not, in San Gabriel. But it was a really cool thing because my mom would come into school and she'd teach everybody about Hanukkah and bring gelt and latkes. And so I became quickly the most popular kid because of that. it was the fun holidays only.
Yep.
But I moved from Pasadena when I was 13 years old, around bar mitzvah time, and to the west side, and I went to Brentwood School, and like everybody was having their bar and bar mitzvah at that time, and it was just kind of a shock.
Were you wondering what all these Jews were doing it here?
Well, I was wondering what I was doing in Pasadena for so many years.
Yeah.
It's like, oh, here are my people. But it was a very interesting upbringing, especially, you know, starting in Pasadena and then moving to the west side. It was sort of culture shock. A lot of people on the west side don't acknowledge Pasadena's existence, but it's a great place to grow up. And you know, I had a great time in living in Beverly Hills and going to school in Brentwood as well.
All right, so you went to Brentwood School, living in Beverly Hills, and where'd you go to college?
So I went to Penn, and had a great time there. It was a great school. Loved everything about it except the East Coast. Didn't love the weather. You know, obviously growing up in LA, it's very difficult to be sort of in hibernation mode for 6 months out of the 9-month school year. But you know, loved the school. Ended up coming right back to LA after graduating.
Yeah, well, you and my wife both went to Brentwood School, different times. Both went to Penn, different times. So maybe that's where the similarities end, though. So what did you do after college?
So after Penn, I started working at Canyon Partners, which is actually where I interned going into my senior year. And I was very fortunate at that time because that was kind of right in the teeth of the GFC. And not a lot of people my year were getting jobs, let alone great jobs at places like Canyon Partners. So I was working, you know, ultimately a lot of rungs underneath him, but ultimately for a guy named Bobby Turner, who ran the group at Canyon. He was, you know, a mentor of mine. He gave me the job on the tennis court. He loved to play tennis.
Oh,
and,
wait, who beat who?
Oh, come on. I knew that I couldn't beat him at that point. You know, that I had to play. I was smart enough at that point to not beat him. But when he told me to win, I won. But I had to be told.
Okay.
No, but he was instrumental in the early part of my career, as was Elliot Benjuya, who is a guy I sat next to my first day on the job, and is a guy who sits next to me in my office today. So, you know, Elliot and we go back, like I said, to my first day at Canyon, and we were a deal team together for many years. We weren't officially a deal team because I was an analyst, he was a VP. And what we did was, you know, anytime a VP had a deal, they would choose from the analyst pool, and we kind of lined it up so that I was always available when Elliot had a deal. So we had a great working relationship, which obviously blossomed in 2013 when we started Tryperion together.
So how many years were you at Canyon?
Well, interned in 2009 and left in 2013.
Got it. So
3 years full time.
3 years full time. So that's pretty young to start your own company. What was it that made you want to form your own company?
Well, I think Elliot and I had a very close relationship, and we saw an opportunity to kind of invest in the sub-institutional deal set. And what I mean by that is at Canyon at that time, we were working out of $1 billion equity fund, and any deals that were under, call it 25 million, were kind of cast aside. You know, the investment committee didn't want to waste time with those deals, even though we were finding very compelling deals below the 25 million of equity range. And so in order to capitalize on those deals, we started our own firm, and we raised $50 million for Fund One, and just focused on, you know, a couple things. Number one, we're value investors. Okay, we'll invest in anything at the right price, and that's a core tenet. And so that kind of makes us contrarians in a way, because we'll end up looking at office buildings in 2023 when nobody else is looking at them. We'll look at indoor regional malls. We'll zig when others are zagging.
This sort of, I think I read Sam Zell once said, "There's no such thing as bad real estate, just bad pricing."
Yeah, exactly.
So he would transact across any asset class.
Yeah, that's our belief. And the other core tenet is we're small on purpose. Okay. I think that the bigger the mega funds that have scaled up to, multi-billions of dollars, they're going to earn beta. All right. They're going to earn market returns because, they're sophisticated investors, but they're competing against all the other most sophisticated investors in the world for the same small set of huge deals. All right. We do the opposite. We look at a very fragmented set of smaller deals. And so in that way, it is easier to outperform.
Was there a deal or two deals where you looked at Elliott and said, okay, we've made it, or you feel comfortable that you are now a proven player in the real estate business? Because I'm sure when, you're leaving Canyon, a couple years out of college, Elliott was a vice president. I'm sure there were some trepidation of starting your own company.
Yeah, that happened pretty quick. And I should mention that, it was three of us. It was Elliott, myself, and Joe Kessel,
Sure.
who was on the asset management side. But Elliott and I were, on the investing side. The deal came pretty quickly. And it was a deal in St. Louis, Missouri. We had contacts. We had a lot of broker relationships throughout the country, but most prominently in the Midwest and the Pacific Northwest. So we had a number of broker relationships in Chicago, and two of those relationships at the same time in 2013, a very soft market at the time. People were still climbing out of the GFC mess. 6 office buildings were being sold in St. Louis in 2 separate portfolios, and they were being marketed by 2 different brokers. And St. Louis is actually a market I know well. My dad's from St. Louis. I've got many cousins in St. Louis. I used to go to St. Louis at least a couple times a year. So outside of LA, I probably knew St. Louis the best of any city. We looked at at both those portfolios, and the pricing was so cheap. And we were, this was a huge deal considering we only had $50 million in Fund 1. But we were really entranced by the opportunity to buy office buildings of that quality so cheaply, with great credit in place, great weighted average lease term in place. And, we followed through, we did it. We bought those deals. We ended up with almost 1 million square feet of office in St. Louis. We were kind of the kings of St. Louis, as
That's not Albert Pujols.
Well, he is certainly, and Mark McGuire
And
still
Mark McGuire.
are kings. But we jumped in headfirst into the St. Louis market in a big way, and I think we earned the respect of a lot of people, not only in that market but outside of that market, who saw, hey, Tryperion's here and they're transacting.
Did you buy that direct, or did you joint venture with a operating partner?
We bought that direct, and there really wasn't, at that time we called ourselves a value add fund, but the play was really buying core plus assets at pricing that could get you value add returns. And that was it. We were matching the high cap rates with a cheap cost of debt. Mm-hmm. Debt didn't differentiate in pricing between a San Francisco and St. Louis. So if you're buying at like a 9 cap in St. Louis and applying, at the time it was LIBOR plus 210 financing. LIBOR was like 10 bips. We were cash flowing in the mid-teens. We didn't need any cap rate compression at the end of the hold. And lo and behold, everybody kind of got cap rate compression over those years.
And how did you convince your investors office St. Louis as opposed to a more typical asset class and location?
Well, that's the beauty of what we do. In the fund business, the funds are discretionary, and all of that is hashed out up front. All of our investors, even now we're on Fund 4, all of our investors understand at this point that Tryperion will evolve with the evolving marketplace. We are not hedgehogs. We're not the multi guys. We're not the hotel guys or retail guys. Because if you ask them, if you ask the multi guys, is it a good time to invest in apartments? Of course it is. It always is, right? But we look at the real estate space holistically. We We'll invest, we're property type agnostic. We'll invest in any property type at any time. We're also all up and down the capital structure.
So if I can just throw, I'm not going to use the phrase double click. I hate that phrase, but just lean into that. So of my client base, I would say the majority of my clients, whether they're on the capital side or operator side, will focus on one or two asset classes. And they will tell me that the reason why they don't have a more agnostic approach is because the equity that investors are looking to put their money with experts in that asset class or even that geography. So how do you differentiate and get the investors to feel comfortable that you don't have to be asset class experts, you don't have to be geography experts, you are real estate experts, and that's spans across asset classes and spans across geography?
Yeah, I mean, I'd say we're truly value investors. That's what we are. We're value investors in real estate. And the way that I convince them that we can do that is take a look at our track record. We've never lost money on a fund deal. If you look at our portfolio today, there's only one deal, unfortunately, that if we realized today, we would lose money on. And that says a lot for having gone through 3 funds fully deployed, 2 fully realized, and having just raised a 4th fund. So, and through the sort of post-COVID malaise or the interest rate spike era, I'd point to our performance. I say, look, we know what we're doing at this point.
All right, so let's talk about 2025.
Yeah.
You just closed your 4th fund, or you launched your 4th fund?
We just had a final closing.
Oh, your final
163 million. Yeah,
it's amazing. I saw the press clippings. I think I even emailed you and congratulated you.
Did. Thank you.
So what are you focusing on? We're mid 2025. We're in an interesting time in the market, right? So we're sitting here mid 2025, and the last 90 days, at least for our firm, has been extremely active. I'm not going to compare it to 2021 activity because I think that's an anomaly, but our firm is fully deployed. Our resources, our lawyers are really at maximum. It started in the 4th quarter of 24, and then obviously the fires hit, which caused a lot of interruption in people's lives, including myself. Tariffs, a recognition that interest rates are not coming down. And so for the 1st quarter of 25, there was a slowness. And now it's ramped back up significantly, at least for our firm. Now, what are you seeing in the marketplace today?
Yeah, well, I'm going to take you through this kind of through the prism of our fundraise.
Yeah.
We started raising Fund 4 in 2023.
Mm-hmm.
At that time, I was pounding my fist on the table for credit, preferred equity, mezz. It was a great time to be at a discount to value and charging, mid-teens rates, which if you charge a 15% rate, that turns into a 16 or 17% IRR when you factor in monthly compounding and points, et cetera. So to be at a 20% discount to value, earning those kinds of returns, it's incredibly attractive. That was 2023. And, the what I was fundraising for was a credit fund. I said, this is the time. But toward the beginning of 2024, I saw a deal that really caught my eye. It was an equity deal. And I thought to myself, okay, do I want to follow through with the credit fundraise, or do I want to pivot? And I knew pivoting would have repercussions like fundraising wise, but I knew that investment wise, it was the right move because the capital markets had evolved. Debt became looser, debt became cheaper, became harder to earn a great return providing preferred equity. And when the debt cycle moves, all things being equal, it means equity is better to be in, right? If debt is cheaper and the equity return looks the same, you're going to do better when debt is cheaper. So, I took the opportunity. There was one deal, it was an office property in Indianapolis, another market that we know very well. 1.1 million square feet in 5 buildings surrounding, it's kind of their century city. It's surrounding the only mall in town with an Apple store. And this property was 68% leased. It's prime product, exactly where your, accountants want to be, where your big attorneys, hotshot attorneys want to be, wealth advisors, etc. And we were in a position to buy that 68% leased portfolio of office on a 17 cap rate. When you buy at 68% leased on a 17 cap rate, there's always the opportunity to bring occupancy up further and your return on cost up higher. So we moved forward on that transaction, and now is really a pivotal moment in the fundraise where we pivoted from credit fund to a special situations fund, investing in both credit and equity. Now, we probably could have raised more money had we stuck with just credit, but it was the right thing to do, to switch it. And we found investors that were like-minded in understanding that you've got to evolve with the evolving marketplace. And so today, I think that it's a really interesting opportunity being on the equity side, because private credit has been sort of the flavor of the month for many months now, and it's getting a little heated. And that will continue to drive returns down for private debt, for real estate debt. And if you can find interesting opportunities on the equity side, you can use that cheaper debt to your advantage. And that's kind of more along the lines of what we're looking to do.
And so the investors that you went out to, I guess, let me even back up. What's the profile of your investors? Pension funds, endowments, family offices, high net worth individuals, foreign capital, all the above?
Yeah. So we've been drawing from mostly family offices, high net worth individuals and family offices. But in this fundraise, we secured an anchor investment from an endowment on the East Coast. And that was a big vote of confidence for us, because that's really our first institutional investor. And they actually, funny enough, co-invested alongside us in that Indianapolis opportunity I discussed.
Through like a sidecar.
Yeah.
And so when you were first fundraising for Fund 4, more of a credit platform, and then you recognized in the market, this is the time to get into special situations, maybe make some equity plays. Your first investors who committed for Fund 4, did they stay with you, or did they say, look, we're only interested in credit?
They did. They stayed with us, and this was mostly the family office set. Mm-hmm. And family offices are generally, they're more nimble, they're more creative. They get it. It's usually the institutional capital that have boxes, and they want to silo you as like either the credit guys or the equity guys, or the hotel guys, the retail guys. So it was an easier conversation to have with them, and thankfully at that point we only had family offices in the fund. It just reoriented the group of more institutional investors that we went out to once we made the decision to switch it to a special sits fund.
So when you're asset class agnostic, when you're cap stack agnostic, when you're almost geographically agnostic, how do you establish, your inbox must be inundated because you are seeing deals throughout the country and all types of deals. How do you have time to make the broker relationships and the other real estate professional relationships in order to get the deal flow that you want to see?
Yeah,
and how do you get on their radar?
We do see a lot of opportunities on a daily basis. We must sift through, 20 opportunities
on a daily basis.
On a daily basis, of course, we throw 19 of them in the garbage immediately. Mm-hmm. But we
except for mine,
yours are always top of the inbox.
Perfect.
And those are pinned. And but besides yours, we have to be efficient with our time. We have to be able to say no quickly, and we do. But we also have the right team in place. So our head of originations is a guy named Greg Rollman. He was at CIM for many years. We've got others on the acquisitions team: Jonathan Etra, who was at Related for many years, Lauren Rickard, who was with East Still and GE Capital. So we've got an institutionally trained team to cover the universe of sub-institutional deals. The other thing that's very important, travel. You mentioned how are you making the broker relationships? We have a heavy emphasis on travel. Okay, I like to say the Southwest Airlines like rolls the red carpet out for us. We're in a bunch of different secondary markets at any time. I was in Austin, Texas last week, Memphis, Tennessee the week before that. Anyway, travel is very important because you're only top of mind to brokers if you're in front of them. So we're traveling a lot, we're shaking a lot of hands, we're also on the phone a lot. If there's never nothing to do in the office, because if you don't have anything to do on any given day, call up the hundreds of brokers that we have in our database. Ask them what's going on. So we're always pounding the pavement.
And so in this fund, are you focusing on buying direct, partnering in a JV equity where you're the capital provider, providing pref, being a senior lender? I mean, I get maybe the answer is all of the above. What are you focusing on right now?
Yeah, it's truly all of the above. We don't mind partnering with best-in-class operators and giving them a promote. When they deserve it, we love sharing the pie. And when we get blowback from LPs, like, why are we getting double promoted here? It's very simple. Look at our bottom line net return.
Mm-hmm.
And if those are acceptable, what do you care, right? So we're forging a lot of relationships with great operating partners. We're doing deals directly with our own asset management capabilities in-house. Kyle Schulman from TPG, Angela Gordon, joined us a couple of years ago. He's been fantastic. And we also, we do creative structures. We did a deal recently where we provided a whole loan to a gentleman who is converting a traditional office building into a medical office building. We took that whole loan and we sold an A participation to a regional bank a relationship bank. And so our B note essentially should earn a very healthy return, but we're not afraid to sort of do some financial engineering as well to get to our return in addition to real estate investing.
Yeah. You talk about double promote, and I've seen investors, pension funds, endowments try to partner or invest directly with operators so that there isn't a double promote. Where do you think we will be 5-10 years from now? The Canyons of the world, the Angelo Gordons, Oaktree, your father founded.
No.
Will equity allocators be disintermediated, and will these pension funds and endowments and foreign investors be able to invest directly with operators? Or do you think the allocators serve a vital need of the transactional real estate business?
I think it's definitely become more difficult for allocators to attract capital. I think that institutional LPs see allocators as almost an unnecessary middleman.
Yeah.
And that's why I say that a lot of the blowback I've gotten has been, why are we getting double promoted? And the reason that we are not only necessary, but really vital to the overall real estate investment ecosystem is because it's what I said earlier. When you ask a multi guy, is it time to invest in multifamily? The answer is always yes. Same thing with the hotel guy and the retail guy. The incentives are not aligned properly for those operators to exercise extreme discipline. That's what we do. Okay. We know all the operators. We know we spend every day in real estate and observing different property types, how the different deals that operators are bringing to us, and we're the filtration mechanism for these institutional partners of ours. We're filtering out the good deals from the bad. And I think that's a very important function.
Absolutely. I mean, it's they're not able, when I say they, the pension funds, the endowments, the sovereign wealth funds, it is from where they sit, it's very challenging for them to select the best in class operators. That's what the equity allocators can do.
And we're a mix of both. Of course,
Sure.
we're not only joint venturing with operating partners who, we're getting we're promoting, but we also do deals direct. But I understand the desire to not be double promoted, but as long as the track record is there, demonstrating that it is worthwhile, I think that allocators serve a purpose.
All right, so then let me ask sort of the flip question then from the operator's perspective. Are they concerned that they could partner with you on one deal and compete against you on another deal because you have the ability to take down a deal yourself and you aren't a typical allocator who only does joint ventures?
Yeah, I don't think so. I mean, the ocean is large. There are plenty of deals out there.
Sure.
Of course, that might go through some operators' heads. Like we do look at similar opportunities, but a lot of times when we forge these relationships with operators, even if we identify an interesting deal, we might say to ourselves, "Hey, there's a great retail operator who would be perfect for this opportunity. Let's bring them in, even though we're sourcing it." And so they they benefit from that dynamic as well. And so I don't think that there's any reticence in partnering with a group that has the capacity to do deals direct because of that reason, and also because we're only as successful as our reputation allows. If we gain the reputation of being sort of sharp-elbowed and figuring out ways to cut people out of deals, we're not going to share a great relationship with many operators.
Yeah, absolutely.
And that's not what we've done over the years. We've played nice in the sandbox.
All right, so if we can get a little specific on the types of deals that are attractive to you, you look at multifamily, and I'll hear that there's oversupply concerns in the Sun Belt of Vegas, Phoenix, Texas, Nashville, Florida. But then flip side, I hear nobody wants to transact in a blue state because of political issues and potential rent control issues. In industrial, we've got headwinds concerning tariffs, and leasing activity has gone down. Office, we've talked about office. Still a lot of challenges in the office market. I know you're a value investor, but can you be more specific as to the couple of asset classes that you're really wanting to dive into?
Yeah. We are bottoms up investors, so we don't look at the macro necessarily and decide from there what to invest in. However, we do have to allocate our time efficiently. So I would say that in this moment, capital has sort of ordained multifamily and industrial as like Teflon, right? You can't lose, and the cap rates today kind of reflect that, and that scares me as an investor. So I don't want to be in any deal with a razor thin margin. So we're not spending a lot of time looking at multifamily equity or industrial equity. Office is very interesting because there's really three categories of office. Only two that everybody talks about, that being like the trophy office building and the commodity office product that is going by the wayside. But I think where investors are going to make the most money is in the in-between. And that is sort of the class B plus building that is either, it's got a great physical plant or it's in a tremendous location. It serves a purpose and has a reason to exist and is desirable. That's being painted with a broad brush, pricing wise. And that breeds opportunity. If we're able to buy in Indianapolis some great office product that's very close to all the action in the best parts of the Indianapolis suburbs at a 17 cap rate, something's wrong.
Yeah.
Right. And I think that inefficiency will eventually be, it'll eventually be corrected over time. But in the meantime, we have the ability to go in there and take advantage of that inefficiency. I think certain kinds of retail as well. We bought an indoor regional mall recently in a tertiary location in California, kind of on the border with Mexico. It was built in 2005. It had never been less than 90% leased since it was built. It was sold by CBL, the big mall operator, was in the top quartile of their overall mall portfolio in terms of sales. We took that cash flow, it was 95% leased when we bought it. We took that cash flow, we paid a 16 cap rate for that cash flow. And that just seems like a mismatch, much more so than paying, a 5 cap for apartments in Dallas, Texas.
Mm-hmm.
I just feel more comfortable with that buffer.
Yeah. And so as you are seeing these opportunities, I know you alluded to it before of being more interested in equity plays. Are you still providing debt? Are you still providing preferred equity?
Yeah, on a one-off basis, certainly. I mentioned that we did a deal where we offered a senior loan to a sponsor who was repositioning an office building to a medical office. That we essentially manufactured our own mezz position there. We also do deals outside of the fund for co-investors who are looking for credit products.
Mm-hmm.
So we've done, for instance, we did a senior loan on condo inventory in Koreatown,
Sure.
which you are familiar with.
Yep.
And that one we also took on a note on note in that case, and retained the essentially a mezz position.
Yeah. So we've talked about real estate for however many minutes our podcast. I want to flip the conversation in our remaining moments. Running a company, right? I run a law firm, but I distinguish practicing law, providing legal service, connecting people is my day-to-day job as wearing my lawyer's hat. But then I have a whole separate job still within Sklar Kirsh, and that's running a company, 60, 65 people, paralegals, admins, HR, finance folks. How involved are you in running Tryperion, separate and apart from the real estate aspect of fundraising and deploying those funds? Talk about what it's like running a company, dealing with HR issues and just having a company in California.
Yeah. Well, the last part of that question is a bit loaded. But,
Yeah.
I can talk a little bit about that because about 3 years ago, I bought out my original 2 partners. And so now I'm the only partner at the firm. And, I'd say a third of my time is spent underwriting opportunities and looking at the investment side of the business. Probably a third is focused on fundraising, and a third is running the business, exactly what you said. And I've come to love it. I've had to learn to love it. Debt management is not something that comes very naturally to me.
I don't love it.
Yeah, no, I mean, it keeps life interesting.
Mm.
We don't do the same thing every day. New challenges come up. You're constantly learning. And then I get to work with great people, and I learn things from them. And it very much feels like we're sort of, in part because the fundraising has been there, we're on this hopefully linear path with a good trajectory, and we're all climbing it together. So it's been a lot of fun. I agree with you. The management part is not always the most fun, but is necessary. And I think at my best, I make it so that I can come home and talk to my wife about how proud I am that, we had this great quarterly retreat and everyone was getting along, and and really feels like we're going somewhere, and everyone's excited. Everybody's excited about closing fund 4, etc. So there are no day is the same. And to your last question about having a firm in California, the state doesn't make it easy for you, but I don't worry. I don't worry about the politics. I kind of just keep my head down. And LA is such a great place to live in. My family is firmly rooted here. The firm will always be here. And so it's not even like I don't think about the politics so much, because there's no reason to.
Yeah. That's hard not to think about, especially these days in Los Angeles. Quick thing on family. Obviously married, and how many kids do you have?
3 kids.
3 kids, great. And tennis in their future, or what's their extra? I know they're young, but what do you think? What do you envision the Karsh clan in a few years?
I would love them to play tennis.
Yeah.
I'd love nothing more than to play tennis with them every day. But my oldest son is a fantastic Connect 4 player. He may go pro. I don't know. He's a good tennis player, but he doesn't love playing sports. He's 8 years old. Mm-hmm. My daughter is 6 years old. She's a killer. Whatever sport she eventually identifies, right now she does gymnastics. Mm-hmm. She's getting started in tennis. She's going to be a killer. And my 3-year-old son, he's still figuring it out. He loves trains, and I love playing it with him. But it's a lot of fun.
That's awesome.
Yeah.
All right, last question. So put yourself back in graduating from Penn, and you're thinking of going into the real estate business. You could go on the equity side, the operator side, the brokerage side, service side. What would you tell a 22-year-old graduating from college now who wants to get into the real estate business? What should they do?
Yeah, I'm actually in this position quite a bit. And what I always say is, if the private equity real estate position is not open to you, which it generally is not to new grads, I think brokerage is the best place to be, because sort of on the sales side. On the sales side, you get to, first of all, you get a lot of reps, which is important. Whether they're closing or not, you're getting a lot of reps. So, underwriting reps, et cetera. And then over the course of sort of an acquisitions process or a purchase process, you start to understand what buyers look for and what sellers look for. And they're totally different, right? They're coming at it from different angles. And that's a valuable skill set to have going into a position on the buy side. So I didn't start out at a brokerage firm, but if I didn't start out at Canyon Partners, I probably would have wanted to go to a CBRE or JLL or one of those big shops.
Yeah. Well, Jeff, I can easily say that not only is Tryperion one of the more respected real estate companies based in LA, I know that you are one of the most respected individuals, not just in the city, around the country.
At least in this room.
At least in this room of two people. Yeah. No, but I want to thank you for coming on the show, and all the best of luck to Fund 4. Although I know I don't need to give it to you because of your great track record, but thanks for coming on.
What a sign off. Come here.
All right. Jeff Karsh, another episode of Real Talk. Thank you.
Thanks.
You've been listening to Real Talk, Real Estate Discussions with Andrew Karsh. You can catch prior episodes at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with